Welcome once again, Dom. It's great to have you on the call.
Hi, it's good to talk to you again. How is the weather on your side of the Atlantic?
It's been incredibly stormy, actually. It's been dreary, just like the markets, fortunately. But
Stormy weather, just like the data.
yeah, no, very volatile. I think that's one. There's certainly one way to read into it. On that front, actually, we've had quite a lot of interesting data, certainly on the US side, in this last week. And obviously next week's got a lot more for the market to digest with the Fed and NFP. But would you be able to sort of firstly just sort of run us through last week's data, and just in terms of obviously the US economy is still roaring ahead pretty strongly, but also core PCE kind of confirmed inflation's coming down at a relatively reasonable levels. So where does that kind of leave the Fed, and what are your views on the detail of the data?
Sure. So, I mean, basically what we had is a continuation of strong growth with disinflation, which is pretty well explained by the positive supply shocks the US economy is benefiting from, so low energy prices, and fast increase in labor supply. So GDP, there was a positive surprise relative to the consensus. Actually, I was expecting a positive surprise, but definitely not as big as what we got, 3.3% against 2% expected. Then this morning, we got the personal income and spending, and again, a positive surprise on spending, 0.7% against 0.5% consensus. And then November was revised up. Basically, consumption in the US is very strong, which is consistent with the strength in the labor market we've seen, and also with the strong consumer balance sheet. What is happening is that households have offset the surprise increase in inflation by cutting down on savings, as they have been able to do that because of their strong balance sheet. So that's pretty much as I expected. Core PC was a tad above my expectations. So basically, I was thinking that we would get a print around 15 basis points, and that the 6 months core PC, that is a key Fed focus, would fall further to 1.8% on an annualized basis from 1.9% in November. And that, this would further highlight the risk of falling into persistent shortfall of inflation relative to the target that we had before the pandemic, and that this would, prompt the Fed to go 50. The data turned out different from what I expected, 17 basis points, but with the revision, actually, the 6 months core PC is the same as in November. It's 1.9% unrounded. So I have adjusted my probability for the March meeting, which is now 45%, 50 basis points, 50%, 25 basis points, 5% no cut. So on the margin, I now see a 25 basis point cut, more likely than 50. But I haven't changed my view for the first half, which is still about 150 basis points, because the story hasn't changed. I mean, basically, you have fast disinflation. You have a Fed that will fight inflation shortfalls. You have the Fed funds rate that is 275 basis points away from the long-term dot. And you have the most contentious election since World War II, perhaps one of the most contentious in the history of the US. And so the Fed would rather cut before things get messy. That means in H1.
Absolutely. And so right now the market's not pricing very much at all. I mean, we've been kind of talking, I mean, the logic behind the sort of front loading of cuts, certainly from our side, it seems to be pretty well placed, and we've been sort of putting out trades, sort of recommendations to back that in our model portfolio. Is there much, do you think, that the Fed could give this week that will sort of shift pricing around? Certainly out to sort of June, where the market's only really priced for sort of 2 and a bit cuts so far.
Oh, sure. So, you know, in the last FOMC statement, there was the addition of the word any to the sentence, any further tightening, which Powell explained in the presser means to convey that the risk of tightening are lower. So I think this week, if my view on a cut in March is correct, the Fed has to prepare the market, and so it's going to change the statement accordingly. It's going to remove references to further tightening or make them very contingent, and it's going to convey that it's more confident that inflation is on a sustainable path to 2%. I mean, of course, you know, there will be, especially in the presser, the usual caveat: if inflation goes up, we will hike, we will be measured and prudent. All the motherhood and apple pie doctrine of central banking, it will all be there, but the message is going to be changed in such a way as to prepare the market for a cut.
Well, certainly. And are you expecting ahead the core PCE will drop back down to, or drop down towards further below 1.9% on the sort of 6-month annualized, do you think, ahead of March?
There is a good chance of that. I think it depends to some extent on energy prices. I'm struck by how energy prices on a seasonal basis rebounded, which I think has given some support to the CPI and to PC. So I think a further move down in energy prices, given the correlation, the return of the correlation between core inflation and energy prices, it would certainly help to pull down core PC. But otherwise, you know, inflation has a lot of inertia. And if you look historically, the best predictor of inflation is inflation the previous period. By that I mean that if you look at the inflation prints, they either tend to be high or low, but there is no middle ground. So given that we are in a period of disinflation, I see it as more likely than not that the next inflation print will be low.
Oh, interesting. Thanks very much for that. And then we also have the labour markets data, so the non-farm payrolls out at the end of next week. What are your expectations around that at this stage?
So I agree with the consensus. I think it's important to realize that for the Fed, it's not the level of NFP that matters, but much more the balance between supply and demand. So things like unemployment, wage growth, perhaps even employment to population ratio. This is what the Fed is focused on, because this balance between supply and demand is what drives wage growth, and wage growth in turn is what drives services inflation, which is the main component of inflation. So I'm expecting, along with the market, a moderation in wage growth from the 40 basis point we saw last month. I just think that we have a labor market that's not geared to transmitting high unemployment to wage growth, largely because we are coming out of decades of low inflation. So institutional features like unionization is low, wage indexation to inflation, there are very few instances of that. wage agreement get renegotiated every few years. So all this suggests, and then we have, of course, a strong increase in immigration. So all this suggests wage growth is more likely to slow than remain at the high clip we saw last month.
No, cheers for that. And is there any other sort of data or releases that you're kind of keeping your eye on for the week ahead?
Well, I mean, we have the ECI, the Employment Cost Index, which is a Fed preferred measure of wage inflation because it corrects for changes in the distribution of employment, between high and low pay jobs. So I agree with the consensus estimate of 1%, which is slow down on 1.1% previously. It's very consistent with the Atlanta Fed median wage, and it just shows that disinflation is proceeding.
Yeah, cheers. And is the ECI coming down being driven by the that's the pure adjusted for employment composition? Sorry.
Sorry. So it's basically an index of wage growth with constant composition of employment. And I think basically what's driving everything down is energy prices. So energy prices in Q4 came down, inflation came down, and so nominal wage growth is likely to come down as well.
And is there any sort of sector patterns within sort of areas that have seen particularly sort of stubborn inflation? Because I know a lot of the central banks, at least in Europe, have been very worried about sort of services wages. Is that the same in the US, or is it quite sort of different?
A bit. I mean, to me, what is striking is that if you look at real wage growth, the median real wage, so the median ECI at the end of September was relative to PCE about 1% below end 2019, so pre-pandemic levels. If you use the CPI, it's horrible. It's 4-5% below. So no wonder Biden is doing so badly in the polls. And then if you do look at the sectoral composition, there are a couple of sectors that have done really well. So food, retail, food services, and accommodation. And I think because they were so low before the pandemic. But other sectors that are super important for the Democrat, like manufacturing, it's extraordinary. The real wage in manufacturing is still below its level of 2019. And so if you look at manufacturing as a sector, since it was targeted by Bidenomics, the only thing that has gone up is the construction of manufacturing capacity. That has almost doubled from a couple of years ago. But employment has been flat and real wages are down. So to me, the puzzle is not so much the distribution of wages, but that everyone seems to wonder why Biden is doing so well in the polls and why Americans are so dissatisfied with their lot. In my view, it's very clear. You look at the real wage data and you get your answer.
Absolutely. And just a sort of flag for our listeners, Dom's put out quite a few things. You've put out quite a few pieces on sort of the potential political sort of outcomes, and we probably doing that increasingly as we get closer to the election, particularly on the sort of risks around the Trump 2.0 that you put out sort of quite recently. So I would recommend people do check that out. Was there sort of anything else that you'd like to sort of flag to our listeners in the sort of near term, or?
Not much. I mean, former President Trump won the New Hampshire primaries, as everybody knows. This really makes him the leading contender. Biden rerun is really the most likely outcome at this stage in the game.
Absolutely. No, interesting stuff for sure. So, I mean, thank you so much for that, Dom. It's always an absolute pleasure to get to chat with you and pick your brain on all these things. Hope you have
Thank you.
continued nice weather, I'm sure, in LA. A lot on it. So, as we sort of always like to do, at the end of these calls, just to sort of flag some of the more sort of interesting recent piece publications. So obviously we do have Dom's Fed preview, which I would recommend everyone check out, and also her piece on the potential effects of Trump 2.0. We've also got a couple of pieces from Bilal, so we've got his macroscope on private equity, which is very interesting. We've got John's piece on his outlook for the Russell 2000, and we've also got in the FX space our sort of backing for long dollar versus sterling view, which kind of aligns also with our kind of central bank views as well. But thanks so much for that again, Dom. I hope all our listeners have a great week and enjoy all our content.
Yeah, good luck, everybody, and keep the feedback coming, especially the negative feedback. It's very helpful.